Good afternoon, folks. There's still a few more that should be coming on, but as they say, man waits, or time waits for no man or woman. So we're going to get started. Christian will do some of the housekeeping, and then we'll get into it.
All right, thank you, Derek. So this is our May office hours edition. So once again, these sessions are to go through some of the great questions we've gotten since our last office hours webinar. We like to go through them in a little more depth than oftentimes we get to do in our actual meetings, and just share some of the great questions we've gotten from you. So as you know, for those of you who have been on webinars before, there's a little bit of housekeeping before we go further. So just a reminder that this material is provided for educational purposes only and is subject to change without notice. Every effort has been made to compile this material from reliable sources. However, no warranty can be made as to its accuracy or completeness. Before acting on any information, please make sure you see a professional advisor for financial advice based on your personal circumstances. Any of the return information is for illustrative purposes only. Actual results may vary from your investments, savings, loan, or other investments available to you. Interest rates are hypothetical and not meant to represent any specific investment. Rates of return will vary over time, particularly for long-term investments. And once again, please consult your financial advisor to discuss your situation before making any financial decisions. All right, so now that compliance is happy, we'll go through our agenda. So what we'll be covering today is first, what to do with your tax refund. Most Canadians get one. What do we do with it? Where do we put it? Second is we're going to look at a few different strategies for paying down debt, the avalanche or the snowball method. Third, we're going to take a look at tax returns and understand the goal behind filing our tax returns. What are we trying to accomplish? What tax numbers are we looking to hit? Fourth, we'll go through the basics on tax installments, what they are, how you end up paying them, how they're calculated, and so forth. Next, we'll take a brief look at why it's best to stay invested during volatile markets. The last year and a bit since COVID started has been quite the year when it comes to investing. So we'll do a little bit of a recap and talk to why it's best to stay the course. And finally, we'll talk about the federal budget that was released recently and just some of the key highlights and how they could impact you. All right, Derek, why don't you start with what to do with your tax refund?
Great. Well, approximately 67% of us get refunds in Canada. That's the most recent stats we have from CRA. But looking at the studies out of the States and from our own personal observations, many households have said that their financial situations actually improved over this pandemic year, and now we're getting into the second year, hard to believe. That could be largely in part to restrictions, reducing travel expenses. We can't go out and eat as much or shop as much. So we just can't do as much as we normally could. There's a wide range of circumstances, though, because some people also lost their jobs and were only partially compensated, so they could be in different situations. So if you found yourself with some extra money over the past year, what did you do with it? Did you save it? Did you spend it? Did you pay off some debt? And looking back now, is there anything you would do differently? So we'll take this opportunity to walk through a number of options for this windfall, either of a tax refund or if you didn't spend as much money last year because your big travel items and some of your big ticket items didn't get spent. So, Christian, did I miss anything there?
No, that's perfect. So we're going to go through it, just a general guide. Like Derek mentioned, it definitely varies from situation to situation. So you want to make sure you take into account your own personal goals and financial plan. But this is just a very high level guide on what to do with that extra cash. So to start, we always recommend building a small emergency fund if you don't already have them. So what that is either $1,000 or 1 month's living expenses, whichever is greater. So a lot of studies have shown that having access to quick cash or a rainy day fund is one of the key indicators of financially successful people, because you're not forced to borrow or lean on other methods or other money such as RSPs if you encounter either a gap in income or an unexpected expense. So we always like to start with a small emergency fund. Next is, if you're not retired already and still accumulating assets, is to max out your group retirement savings match. And what that means is, if you have any sort of group retirement plans, like a defined contribution pension, a group RSP, or other group savings plan, where they offer a match, so they'll match 1% of your salary, 2% of your salary based on what you put in. We would want to max that out, because that's free money we're getting from our employer. So we want to make sure we're taking advantage of that extra money that they're offering. At this time, we wouldn't contribute anything more than the maximum amount the employer will match. So we just want to start with maxing that out. The next is paying down high interest debt. So generally, high interest debt is anything with an interest rate of 10% or more. That's generally what the rule we look at when we say high interest. Now, mind you, there's not very many debts in today's interest rate environment that are at 10% or more. But if you do have any high interest rate debt, this would be a good chance for you to put some of that extra cash towards debt. Now, before we look at paying down debt, once again, this is where it varies based on your situation. It's important to evaluate which debt pay down method, avalanche or snowball, is right for you. We'll have more on this in a minute, but this is just an important consideration when looking at debt. Although we say pay down the highest debt here, or the highest interest debt, and depending on how you feel about your debt and the different debts you may have, that may not be a hard and fast rule. Next, we'd be looking at increasing that emergency fund. So we started with 1 month's living expenses, or $1,000. Now we have enough cash. We've maxed out our group retirement savings match. We've paid down our high interest debt. Now we want to build that emergency fund to about 3 to 6 months worth of living expenses. This number, it's important to have, because we want to make sure if our source of income is interrupted, either by losing a job, like many Canadians experienced during COVID, or if you're retired and the markets take a bit of a dip and we're worried about drawing from our investments when they're down, we want to make sure we have at least 3 to 6 months worth of living expenses in cash that we can live off of to bridge that gap. Next up, we want to pay down moderate interest rate debt. Once again, I'm going to reiterate what we said earlier. It's important to evaluate the avalanche or snowball method depending on your debt. But based on this general framework, we would look at now paying down any debt that's around 4 to 5% interest. So anything kind of in that moderate interest rate, that's what we would look at paying down next. Finally, after that, we've paid down all of our high interest debt, low and moderate interest debt. We have our emergency fund. We're maxing out our group retirements matching. Now we want to increase our savings or investments. So looking at specific target, it can vary widely depending on what your goals are. But oftentimes some people like to target a percentage of income, like 15% of your pre-tax income. So these savings or investments could be used for retirement, could be used for any large purchases you're looking at, or any personal investments like education, if for children or grandchildren. So that would be the next step on where to go with extra cash. And finally, allocate based on your goals. So after this point, if we're saving a healthy amount towards all of our different expenses, then we take a look a little bit more specifically at our own personal goals. Are we looking to do some traveling? Are we looking at having a little bit extra fun money to spend? Those are some of the things that we would look at allocating based on. Finally, we'd like to celebrate. So we've put a lot aside, we've paid off our debt. Now it's time to just reward yourself. If there's really not any other areas that we can put the funds to, it's important to also reward ourselves and have a little fun when we get some extra money. Derek, anything to add on that?
Yeah, the one thing I would just add is, and it may not apply to anybody listening right now, but the small emergency fund is so important, especially for younger people or where they've got debts and credit cards, car loans, and all those kind of things. And when we get into talking about the debt pay down, even when people have a large number of debts, we really encourage them to build up a small emergency fund, because there's such a change in the mindset when the fridge breaks down or the car needs to go in for repair. and you know your credit cards are maxed out or you've got no room on your line of credit, but you've got $1,000 of cash sitting there, you know it's covered. It just gives you a lot more peace of mind. So as we get into more people that are into retirement, we look at actually even longer periods of sort of short-term availability of funds to fund, you know, maybe up to 2 to 3 years worth of expected needs or withdrawals from their portfolio, because they don't have as long to recover from market drops. We want to make sure that we've got adequate supply there to, again, give them peace of mind and allow them to sleep at night. So what are we getting into next? Paying off debt. So Christina talked about the avalanche and the snowfall. Both of those are gone right now because it's springtime. We ordered extra sunshine for today and we're getting it, and a little bit of heat with it. So both of these would get melted very quickly. But very simply put, an avalanche, it can be slower to start. Starts off as a rumble in the distance, but once it gets going, it literally clears out everything in its path. Basically, you use extra funds to pay down the highest interest debt. So if you've got a loan at 3%, one at 5%, one at 7%, and one at 10%, you pay the 10% one off first while applying minimums to all the other ones. Now that's the most financial sense. The only problem with that is that it can actually be discouraging, especially if that one happens to be one of the larger ones. It means that we're going to have quite a long period of time before we see anything get paid off. Now, we will save a little bit more interest if we stick with it, but one of the things is that it may discourage us and we may end up running debt back up again. So when you look at the snowball, it starts out very small and then gains momentum as it comes down the hill. And we've used this very successfully with people from all walks of life, some very high rollers that were spending their net instead of their gross income, forgot to account for income taxes and things like that. So what we do in this case, you've still got 6 or 7 debts, but rather than choosing the one with the highest interest, which most people automatically say, I got to pay this one that's the highest interest, we say, what's your smallest debt? Pay minimum on everything else and apply any excess funds you have on that smallest one. And in many cases, within a month or 2 months, often you can get a little, you might only have like $300 or $400 on a credit card or something like that. Get it paid off. Then you can tick off the box. Many of us like to have a to-do list, and so we list all the, you know, the 6 or 7 debts or whatever they are. And boy, it's really nice to pat yourself on the back, go out for an ice cream or something to celebrate that you've made progress by saying, whoa, I got that one paid off. Who cares if it was only $300 or $400 and it was a low interest rate? You got it paid off. That's one less payment to worry about. Your situation starting to get a little simpler. And we find often that even though technically you're paying more interest, most people will stick to this and get their debts paid off faster than if they went with the avalanche method. So even though financially it doesn't sound like it'll be better off, in most cases, because it emotionally gets you more engaged, the snowball tends to work better for the vast majority of people, and you get out of debt that much faster and actually do save money. Did I miss anything on that, Christian?
Oh, that was great. And oftentimes we say the best plan is one that we can stick to. So that's why with the snowball and the avalanche, if we just looked at the numbers, we would always say, well, pay down your highest interest debt first, because that'll save you the most. But like Derek mentioned and did such a great job of explaining, oftentimes that can be difficult emotionally and mentally to stick with, because you don't feel like you're making a lot of progress, especially if that debt, the highest interest rate debt, is pretty big. It can take a while for you to finally clear that. And eventually, a lot of times people can end up just giving up. So it doesn't really make sense for us to pay off the highest, try to save a little bit of interest if we're just going to fall off the wagon and not actually pay off our debt. So that's why the snowball method can be so effective, because like Derek mentioned, you clear the small debt, you get to reward yourself, feel good about having just one less debt to pay down. And as you start to pay off some of those smaller debts, you have more free cash to pay off the next debt you tackle. And then it just builds and builds and builds. And before you know it, the $20 extra you were putting towards your small debt is now turned into $400 or $500 or more, paying off some of the bigger debts, and you can really gain some momentum. So that's really all we have on the 2 debt pay down strategies. So next we're going to go into a little bit of tax details. So when we talk about filing our tax returns, really we want to start with what is our goal? And there's a few different options. So there's owe tax, get a tax refund, or have no tax due or no tax refund. So get as close to the 0 mark or nil balance, the CRA will call it, as possible. Now, most people know we really don't want to owe tax when we file our tax return. That just means that we haven't paid enough throughout the year, and the government's going to want a big check, potentially big check, when we file our returns. So it's pretty straightforward that we would want to avoid that. Now, what most people don't often realize is that having a tax refund is not necessarily the greatest thing either. What this means is we've essentially loaned the government interest-free money for a few months, almost up to a year, depending on when we got our income. Because when the government gives you a tax refund, they don't give you your tax refund plus interest. They essentially just say, hey, thanks for overpaying your taxes for a few months. Here's what you overpaid, but we're not going to pay you any interest. And as anyone who's ever gotten into any trouble with the CRA in terms of paying your taxes too late, you know that they wouldn't do the same for you. They're going to charge you interest. They're going to charge you penalties. So we actually, in most cases, we don't want to get a refund as much as possible, especially not a large refund, because it just means that the government has had our money instead of us having our money. So really, when we try to file our returns, we want to get as close to 0 as possible, because that way we know that we have as much money in our pockets as we possibly can throughout the year, and we're not giving extra to the CRA or not giving too little to the CRA and having to pay out when we file our returns. Derek, anything to add on that? Oh, Derek, you are muted.
Sorry about that. No, it's a great explanation, and just one illustration. Some of you have allowed a CRA authorization, so we can see RSP limits, TFSA limits, and all those kind of things. And we use that for many of you to do a tax projection, usually in the 4th quarter of the year. And we're not accountants, we're not CPAs, but we do have tax software, and we are pretty good at what we do. So our best one, we did a projection, we drew a little bit more money out because it was tax effective, and we ended up within $58 of plus or minus getting no refund or owing money. So we were pretty proud of that. That was our closest one. Some aren't quite that close because sometimes we don't know what dividends or investment income will be, but we're pretty good at figuring out the different sources and estimating what that is. So that's our goal, to help clients get to that point where there's no tax refund, or minimal. Like, we'd like to be plus or minus $500 sort of either way. So let's go on to the next one, which is how to get your tax deduction early. So if you are getting large refunds, $2,000, $3,000, $4,000, while it seems nice, and a lot of people, especially when they're working, will use that to say, oh, that's going to be our summer vacation, or that's going to be my deck project, or whatever. As Christian explained earlier, we're really loaning the government our money at no interest, just to have them give it back to us later. So you can get a tax deduction early. There's a form called, government has a form for everything, so it's called a T1213. So it requests a tax deduction at source. Now, again, if you're working, you fill out the basic exemption forms and they take off the tax accordingly. But oftentimes they don't know that you're maybe making large RSP contributions, that you've got large charitable donations, that you have childcare support. You could have gone through a separation situation and you have tax deductible support payments. So there's a variety of reasons that you might have extra tax deductions. And if those are consistent and regular from year to year, you can fill out this form and request to have less taxes withheld at source. So your employer will actually reduce the amount of tax they're deducting, so you get that every paycheck you get that extra money and you don't get the big refund at the end of the year. So you don't get it both ways. You can't have a big refund at the end of the year and file to get the extra tax deducted at source and have it every month. But I think we've got buttons. I've listed some points, but I think they come up on the slide. Yeah. So it does have to be filed annually. And some of the reasons, as I mentioned, you've got large RSP contributions, childcare, support payments. A few people have employment expenses or commission salespeople, whatever. If you have carrying charges from perhaps tax deductible investment loans or so on, if you've got high and consistent medical expenses or charitable donations, all of those can be used to request a tax deduction at source. So one example that's sort of the opposite of this, any of you, if you are working or were working at a place that had a group RSP matching type of thing, when you contribute to a group RSP through your payroll already knows that you're putting into an RSP, so they automatically make that deduction. And in essence, the employer is doing the equivalent of filling in this T1213 request with CRA because they know that you're getting a deduction and they can reduce the tax withheld. But for those of us that don't have a contribution made through our payroll, and we're making it to an independent RSP program, if we want to get that tax deduction at source, then we need to fill out this form and send it in annually. Anything that I missed on there, Christian?
That was great. This is this form most people don't know about, but it is an option available to give us a little bit of extra cash flow throughout the year instead of getting that one big lump sum. Because like we said earlier, if we're paying too much tax throughout the year, that essentially means we're loaning that money to the government and not getting any interest. So at least if we have it throughout the year, if we want to save it or invest it, we can earn a little bit on that extra money instead of having it go to the government and getting it all back.
Just a final thought on this, as Christian goes to the next slide, is if you're only getting a $500 or $1,000 refund, it's not likely worthwhile to go through and fill this. But if you're getting $3,000, $4,000, $5,000, $6,000 a year back in a tax refund, that's an extra $400 or $500 a month that could be in your pocket. So that might mean that if you're still in the contributing stage, that's money that you could be contributing throughout the year instead of waiting till the end of the year and getting a larger lump sum.
Mm-hmm. Exactly. And so that's one way to get your tax deduction early if you're paying too much tax. There are a few other methods depending on where you are. And in most cases, this is for those who are already retired. You can actually adjust the withholding tax on different sources of income, like old age security, Canada pension plan payments, any pension or RSP or RIF income. You can actually adjust how much tax to some degree you have withheld on these payments. So OAS, old age security, Canada pension plan, you can actually have no tax withheld on those pension payments. So if you are ending up with big refund or big tax owing, you can pay more tax on those pension incomes directly so that you don't pay a big bill at the end of the year. Same thing with any group pension programs that you're a part of. If you're making any RSP or RIF withdrawals, there's a lot of flexibility on how much tax is taken off on that income. There are some minimum amounts that have to be withheld that the government will mandate on these kind of withdrawals. So anything 5,000 or under, it's 10%. 5,000 to about 10,000 is 20%. And then, or sorry, 5 to 15,000 is 20%. 15,000 above, they have to withhold at least 30%. So there are some restrictions in place or some rules that we have to follow. But if we need to pay more tax, then we can certainly look at doing that on RSP and RIF income. Another option is to pay tax installments when required. Generally, we try to avoid this, but in some cases, this is what an accountant will recommend, is that you pay quarterly installments in order to make sure that you're not owing money at the end of the year. And Derek will actually touch on a little bit more on tax installments and kind of what situations that those would apply. Derek, anything to add on that?
Yeah, that's the one thing, as many of you will be aware, when we do our tax optimization, and even if we're not doing a tax optimization, if you're in a RIF program, we take a look at what your taxes, what we estimate your tax bracket to be. And so we'll adjust your RIF withdrawals, taking a specific amount of tax off. Some people we take off 13.5% because that works out to them getting a slight refund or owing only a little bit. For others, we have to take out a larger amount. For others, we take a lower amount. But again, the whole goal of using the RIF, it's sort of like a balancing tool. There's a certain minimum amount of tax we have to pay, but if that's coming in on top of other income, you might be in a higher tax bracket, and so we don't want you to end up owing with a whole bunch at the end of the year, so we make that adjustment to avoid the quarterly installments, which is what we're going to talk about now. So who has to pay them? What are they? When do you have to pay them? Where do you go to pay them? Why and how? So let's get into that. So who must pay installments? Well, basically they look at the last 2 years' tax returns. If tax due on filing is greater than $3,000, either in 2020 or in 2019, and you expect to owe more than $3,000 on your 2021 tax return. And by the way, the government assumes that if your income in 2020 you owed $3,000, they're assuming that you are going to have exactly the same income, maybe plus inflation in 2021. So they're going to say, oh, okay, well, let's make sure that you pay installments. So there are many cases where investment income, for example, you can receive dividends, you can receive interest from GICs or bank accounts, you can sell a stock or a mutual fund and have a capital gain. When you get that money, or in some cases, that money isn't even in your hands, it shows up on your tax return, but it just gets automatically reinvested and buys more units or more shares. But you still have to pay tax on that. Now, nowhere in there do they send any money to CRA and say, oh, this person should be paying 10 or 20 or 30% tax. So all of a sudden, you've got this extra money coming in. And if you don't have an RRSP deduction, some charitable donations, medical expense or something to offset that, then you're going to end up owing extra tax money at the end of the year. Self-employed people as well, they don't necessarily get a payroll if they're just working. They're filing their own returns. They're self-employed and then just showing it as personal income. And then they write off all the expenses. So they might bring in $100,000, but if their expenses are 40, they only have to pay tax on 60. So there's all these different things that need to be taken a look at. How much actually gets sent directly to CRA? I had one client, this was a senior, and actually was her daughter, was saying, gee, my mom got a bigger tax return last year and her income was lower this year. I said, well, actually, your mom isn't paying any taxes. All she's paying is the Ontario Health tax. So there is no income tax being paid because she had enough deductions with her medical expenses and so on and a relatively low income. The pension income credit, the age exemption, all those other things gave her no taxable income, but she still had income, net income, that required her to pay the Ontario Health tax. So you're not going to get a refund if you haven't paid any tax. So that's the other part of it. CRA takes a look at your level of income, the deductions you have, and say, okay, how much do you owe us? If you haven't sent us any during the year, then you need to pay up. And if it's a larger amount, like as in this case, over $3,000, they're going to want to pay it on a regular basis so they're not too far behind. All right.
One thing to add on that too, on that second line, this is often where having an accountant versus filing your own taxes can make a bit of a difference. So when we talk about you expect to owe more than $3,000 on your 2021 return, oftentimes this is where it'd be great to consult with an accountant because they would be able to help give you a better idea. The CRA may just, like Derek said, the CRA will assume that you're going to owe the same amount of tax the following year, but your accountant may be able to work with you to figure out whether or not you should actually pay those installments that the CRA requests, depending on what your income will be. Once again, this is why it's important to consult with your accountant if you have one when you're looking at paying tax installments, as well as working with your financial advisory team, because they'll be able to work together and figure out maybe, the last 2 years, our income tax was a lot higher because we had a certain bonus, or like Derek mentioned, some investment income that we don't expect to continue. So that's where it'd be important to loop in the tax accountant as well as your advisor to make sure that if we're going to pay installments, that we're paying them, that we're only paying what we have to pay.
Excellent point, Christian. And just as an example, some people have sold a cottage or a rental property and had a fairly large capital gain. Well, of course, there's no tax withheld on that. So it bumps you up into a higher tax bracket, and most people end up owing a fair bit of tax on that. Immediately, CRA asks for quarterly installments, but that was a one-shot deal. And you're not going to be selling a cottage or a rental property every year, or at least most of us aren't, because if you have one cottage, you're doing pretty well, or one rental property. So in situations like that, again, it's totally not worth paying installments. If it hadn't been for that and you wouldn't have owed some money, then you don't need to worry about it. But again, as Christian said, talking with your accountant or your financial advisor should be able to confirm that.
All right, so how do we calculate installments? There's actually 3 different options. So the first is just a no calculation option. So the CRA will send you installment reminders and they'll request certain amounts throughout the year, and you can just pay them as the CRA requests. That's oftentimes the easiest and most straightforward option, because they send you the reminder and you pay it. There is an option to pay it based on the prior year's tax return. So if you think your income, deductions, and credits are going to be similar to last year, but different than the year before, we would look at the prior year option. So if you think your 2021 income will be pretty much the same as 2020, then we can use your 2020 income to gauge how much tax installments to pay. And then there's also a current year option. So if you think your income, deductions, or credits are going to be significantly different this year than they were in either of the last 2 years, you can take a look at your current year's income, current year's deductions and credits, and calculate your installments based on that. Derek, anything to add on these 3 options?
No, that's a good summary. They like to give you options, and we need to know which is the best option for us. And again, that's where an accountant or your financial advisory team can give you some guidance on that. So when do you have to pay them? Well, they like things orderly and done in a quarterly fashion. So the 15th day of the end of each quarter, March 15th, June 15th, September 15th, and December 15th. So you're, depending if it's a first time or a repeat time that you have to pay installments, when you get your notice from CRA with your notice of assessment and saying you need to pay quarterly installments, they may initially have a different date, but that's the standard dates that they want them to pay by. And I think, oh yeah, okay, so let's say the next slide, I believe, is about how do you pay them? Okay, so there's a number of options here. Literally, the government will take your money any way they can. Debit, online banking, you can set them up as a payee, pre-authorized debit, credit card. They don't really care if you have to pay 19% on the credit card because you don't have the money to pay it, but they'll take it. You can go in person at a financial institution, or you can even go into Canada Post and pay it there. One that's not listed here doesn't work anymore. It used to be able to give your firstborn child, and that would cover you for a couple of years, but they don't take that anymore.
So what happens if we don't pay our installments? So like we talked about earlier, when we overpay the government, they don't give us interest on the money we paid them with our tax refund. However, if you don't pay the taxes you were supposed to pay, they will charge you interest daily. So this is based on the prescribed interest rate, which is a rate set by the government every year. Right now, I believe it's still 1%. And they will charge interest every single day. Now, you're not charged 1% every single day, but you're charged a daily rate of interest. There will also be penalties. The penalties will be based on how much interest you owe, and there's a bit of a formula here on how they're calculated. So they will use this formula to calculate, on top of the interest that you're going to be charged, what your penalties would be for the money that you were supposed to pay in the quarterly installments. Now, one question is if you didn't pay your installments when you were supposed to, how do I offset that interest or those penalties that I've been charged? Because the second we miss an installment, that's when they start to accumulate the interest and penalties. So you can actually reduce those installment interest and penalties. So this would just basically mean either paying your next installment earlier or paying a little more to offset the amount that you were supposed to pay last time. So if you missed an installment, it's not the end of the world, but we want to make sure that we're making up for it before we file our next tax return. Derek, anything to add on that?
And the big thing there is to make sure that you get the required amount, either what they've asked you to pay or enough to cover whatever tax you're going to owe before December 31st of the tax year. Because even if you apply it January 2nd and you say, well, I paid the money and my tax isn't due until April, the government says, no, you earned the money in 2020, but you didn't pay the tax until 2021. So we're still going to charge you interest and late filing penalty because you didn't file in time. As long as you get the total amount in before December 31st of the same tax year, then it's not really late because you end up getting a refund or you've paid them exactly what they asked you to, and you may still owe a little more, but you've abided by their rules. So that's the only thing to be cautious of, is make sure you pay it in the calendar year of the tax year that you're talking about.
Great point.
So
last off, just if we want to avoid paying installments, we touched on this earlier already. You can adjust the withholding tax on some of your pension incomes, old age security, Canada Pension Plan, RIFs, as well as your employment income. That one's a little bit trickier. They won't often do that depending on your payroll, whoever's in charge of your payroll. But by paying more tax ahead of time, you can oftentimes avoid having to pay installments. Derek, anything to add on that?
Oh, that's exactly as we've covered before, and we've, again, done with many clients, is where we've used the RIF as the adjustable. Most people don't have much, if any, tax taken off old age security or CPP. They have to ask for it. It doesn't happen automatically. So oftentimes we'll just say, okay, leave that. You already know that's coming in. We'll just take a little more tax off the RIF to be the equalizer so you don't end up with a big tax bill. So we can encourage clients to do whatever the easiest thing, simplest thing to do is. And oftentimes it's easier to give us a call and say, I need to have a little more tax withheld than trying to get through on one of the CRA lines to old age security or CPP. Our wait times are usually a lot less than CRA.
Yeah, that's right. So Derek, we're going to move on to why it's best to stay invested in scary markets. So why don't you take us through this?
All right. Well, there's no such thing as a scary market for you seasoned investors. You've been around for a while. And anybody that's been invested for more than a year now has been through a scary market, and it's not so scary. Although sometimes that happens over a much longer time period. Anyhow, if you recall, a little bit earlier than this, March 23rd actually seemed to be the low day on stock markets around the world in 2020, just after the initial stages of the pandemic hit. And markets dropped. A lot of the stock markets dropped up to close to 50% in a matter of 5 or 6 weeks, from highs in mid-February, early to mid-February, to March 23rd. And fortunately for us, because we talk about long-term and financial planning, having emergency reserves and so on, we didn't really have a lot of panic clients. We didn't have anybody that wanted to sell and move to cash and wait till things got better. We said, you've got a balanced portfolio, you're going to be okay. And lo and behold, we didn't know what happened this quickly, but literally from March 23rd, things started moving up, and not quite a straight line up, but pretty close. So we're using dimensional funds, their portfolios here representing different mixes. And just to show you, had you been in the one that's listed at the top, DFA Canada Global Equity Portfolios, that's 100% invested in stocks from around the world, roughly a third in Canada, a third US, a third internationally. If you follow the line, you see that it had the biggest dip starting in March 23rd to early April. It was down significantly, but lo and behold, 1 year later, it's got the best return. Now, sometimes it doesn't happen that fast, but that's the importance of staying invested. Had you sold out during that low point in time, now when you buy back in, you've done the other. Everybody knows you want to buy low and sell high, but our emotional reaction, our gut reaction is fear, get out of here, So what do people do? If you historically track fund flows into stock markets or into individual stocks and stock-based mutual funds, although everybody says they want to buy low and sell high, when we track the money, we see that more people sell low and buy high because it feels good. They're looking in the rearview mirror. And when we get to this high point here, or even maybe here, they go, oh, look what happened. Look how well I'm doing. Let me jump in there. Unfortunately, you haven't been doing that well. You've been sitting down here because you sold out here, and so you've lost out. So really all this shows is, for example, a standard portfolio is close to a pension fund, this orange one in the middle, 60-40 fund. So it's sort of middle. It's got 60% stocks, 40% bonds. It's still got some growth potential because of the stock side of it, but the fixed income side of it cut the downside by less than half. So you didn't see as big of it. It smooths out your roller coaster a little bit. It goes from one of those loop-de-loops at Canada's Wonderland to more of a kiddie coaster. So if we just take it from the down point, not from exactly the previous point, but right from the low point, the 1 year returns for this pure stock fund was over 50%. And even the fixed income fund was up over 4%. So just 100% bonds was up 4% from that low point, because even bonds suffered a little bit during that decline because there was so much fear in the marketplace. So as I said, this was a microcosm of what happens in the longer term. This happened all literally within a year and a little bit. We saw highs, big drop, and then a quick recovery and back to new highs. Oftentimes, it's a much longer, more extended period, like 2008, 2009. Depending on the markets, that period of time, very similar to this as far as how much it dropped from peak to the trough, and then the recovery. But that took place over a 3 to 4 year period rather than 12 months. It's a lot easier to live through these kind of things in a 12-month period than it is over 3 or 4 years. Can you imagine if we took this and we stretched it out so that it took you a year and a half to go down? I mean, people, if they're looking at their statements on an annual basis, not so bad. If they're looking at it quarterly, they've now seen 4 or 5 or 6 quarters that it goes down, down, down. They start to get pretty depressed. And for those poor souls that look at it every day, they might be trying to get prescriptions for a depression medication or something if they're looking at it every day and watching it go down literally every day for a year and a half. And again, nothing wrong with looking at portfolio on a day-to-day basis if that's of interest to you. But really what we're looking at is we know that we're going to be around for presumably a long time, and therefore we need to measure our investments over appropriate periods of time. And if you got anything in stocks at all, looking at it on a day-to-day basis is not a good way to sleep peacefully at night. Christian, anything else?
Derek, you made a lot of great points, and something I just wanted to add on is humans were not wired to be good investors. And Derek mentioned oftentimes the goal is to really buy low, sell high, but most often people end up buying high and selling low. And that's because we've evolved to essentially when we're afraid is we run to safety. And that's in investing, that can be oftentimes one of the worst mistakes we can make. Because if, like Derek mentioned, if we would have went to cash and taken everything out of the markets after the big downturn last March, you would have seen that we would have missed out on quite a huge return. And that's a pretty common trend, actually. And I'm going to show you another piece here. So this tracks actually the S&P 500, which is the US top 500 US stocks over the last just over 20 years, about 25 years. So you can see the first period we look at was just before the dot-com bubble. So when we're looking at that period here, I'm going to bring up my little laser pointer here. So you can see that from the end of 1996 to the peak of the dot-com bubble in 2000, stock markets were up about 100%. And then the next basically 2 years, they were down about 50%. Now, it would have been really easy at this point, looking down in about October 2002, to say, you know what, I can't take it anymore. I got to get out. It's been 2 years. Markets have been going down almost 2.5 years. I've got to move to cash. Well, if you did that, you would have missed out on the next 5-year return of 101% cumulative. Not every single year, but over the 5 years, they returned about 100%. And you can see they were right back to just about where they were at the dot-com bubble. And you can see that trend repeats. Then we have the financial crisis where the stock market was down over almost 60%. And once again, it would have been very easy. This was over a little bit shorter time, about 2 years almost, to move to cash and say, I can't take it anymore. The market's been going down for a long time. I need to get out. I need to move to safety. But if you would have done that, you can see the next basically 12 years were a 401% return over that 12-year span. And see, they really took off. And then once again, we have COVID. So now we hit all new highs, and then we got a really big dip throughout COVID, which actually took place in only a month compared to a couple of years with the last returns. And the exact same thought could have gone through our head. It's in the last month, markets have gone down almost a third. I need to get out. I need to move to cash. However, if we would have done that, this is where you could see it would have been greatly exacerbated, because the recovery was so much faster than the last two periods, the dot-com bubble and the financial crisis, and we would have missed quite a substantial return. Historically, this trend continues when we look back at even prior periods before 96. But oftentimes the best years or the best returns are immediately following the worst returns. So this is why it's really important to stay invested even throughout those bumps. Derek, anything to add on that?
I got 3 points I'd like to add. It's well explained. First one, I'll call it's the funny investment math. We're using percentages here, but let's use a dollar figure. If you invested $1,000 to begin with, now more than doubled. You got $2,000 at the dot-com bubble. Then it dropped almost 50%, but it doesn't drop 50% of your thousand. It drops 50% of the 2,000. So you're back to square one. Now it goes up, it doubles again. You're back up to $2,000. And again, it drops by that. So literally, if you started investing in 1996, where this indicates with $1,000, you basically would have been the same place at the low point in 2009. Now this is investing in one stock index. And so again, what it points out to is that people say, oh, we had 100% return. Well, that's great if you were just started to invest there. But if you had invested, say, the prior year and you had already experienced a 50% loss, you need the 100% just to get back to even. You don't just take the two numbers and say, oh, so I got an average return of 25%. That's not how it works, which is why it's so important, A, to diversify your portfolio, because if you've got 50% in bonds or 30% or whatever, when stock markets drop down, you have the opportunity to rebalance and buy some of the stocks low. A, you won't drop as far, and B, you're having the opportunity to buy low, so your ride won't be nearly as rough as this. So diversification by investment type, by geography. Had you invested in Canadian markets and international markets as well, you'd have had a slightly, even if it was 100% stocks, you would have had a bit of a balancing over this time period. So that's the second point. The third point is more of a funny story. A client that came into my office, literally holding a statement, and his hand was shaking so bad because he was a GM retiree, or the couple was GM retirees, and they were concerned about their pensions being lost and so on. They did have investments, but he says, like, if GM goes out of business, we lose our pensions, and we've got to rely on the investments. What are they going to be like? They're going down. We talked them through that. I said, even though GM, because GM hadn't declared bankruptcy yet, I said, even if they don't, there's still a lower level that your pension is still guaranteed. You're not going to be totally out of cash. You've got quite a conservative portfolio. You're not down nearly as much as the market. We've got enough money in the safer part to draw for 4 or 5 years. I'm sure that things will recover by then. So fast forward to last year, this guy that was shaking, he was so fearful. He called up and he says, well, he says, markets are low. You've always told me it's good to buy when markets are down. He says, so now he's, 12 years older, and he was already retired in 2008, 2009. He says, how about we move some of the money from our safer bond funds into some stock funds inside the TFSAs? I said, well, I can't I can't argue with that. I've been trying to tell you that for the last 20 some years, sort of jokingly. So we did. We didn't move everything, but we made a minor move. We moved some money in each of their tax-free accounts into stocks, and I had to call them up afterwards and say, you hit that within about 2 days of the bottom of the market. And it helped boost his overall portfolio returns by over 1% just by rebalancing while it was low. And having him do that, one that was so fearful of the markets going down before, and seeing how he's now older, but he's experienced more of these ups and downs and see how they've come through. So that's the value of keeping that long-term perspective and realizing that, what happens on a daily basis is a very short perception to look at, and we should, for the most part, unless it's a wild tiger chasing us, we should step back and say, okay, we don't need to actually jump right now. Let's take a look and let's think this out to the logical end of it. All right.
Right. So the last thing we're going to touch on is the 2021 federal budget. So there's a few highlights here. We won't go through the entire document because it was one of the largest budgets, I believe the largest budget in history with over around 700 pages. But we pulled some of the key highlights and some of the programs that a lot of people have been focusing on from this budget. So the first thing is tax rates are going to be remaining the same. There was talk about potentially increasing capital gains tax, and even potentially personal tax rates, but there was no changes to our personal tax rate or business tax rates. Some of the COVID relief programs, so that would be now CERB is no longer in effect. It's been replaced by CRB and a CSB, Canadian Sickness Benefit, Canadian Response Benefit, very similar programs, but with slightly different features. Those have been expanded and the deadlines for those have been extended. One of the biggest proposals coming out of this budget is the Canada-wide early learning and childcare system. Now, this is great for somebody like me who has a 4-month-old at home, because the goal of this program, and for those who aren't familiar, is to mimic Quebec's childcare system. So Quebec has a childcare system that essentially limits the cost of daycare to $10 a day. And what they've found is that this is actually a net benefit for their economy, because oftentimes what ends up happening, majority with women, is that someone has to stay home with the kids because the cost of childcare is so expensive that it's just not worth, unless they're both partners are making a really substantial income, for one person to keep working with 1 or 2 kids in childcare. So what they found is that by subsidizing childcare and limiting the cost to citizens to $10 a day, that their economy is actually able to grow because there's more people working, and more people are able to stay working because of the childcare system. So this is something that the government is looking to extend throughout all of Canada, and it'll be phased in over a number of years, assuming this budget is passed. And that's something that they're looking at expanding throughout the country, which, for someone like me, is very much looking forward to that, because as most of you are probably familiar, the cost of childcare can be quite expensive. Derek, anything to add on those 3 programs before we go forward?
No. Might get in for some of my younger grandchildren.
So the last 2 pieces are more for, I would say, more for retirees. They're looking at increasing old age security for Canadians 75 and over. So this would be to reflect the fact that people are living longer and longer. So we're looking at increasing the amount of old age security for anyone who's age 75 or up. Derek, do you remember the specific figure? I can't quite recall off the top of my head.
They are planning on a $500 one-time deposit in August of this year for 2020. And then effective July of next year, they want to do a one-time 10% increase. So right now, the old age security is about $7,600 a year. So that'll be a $760 increase over the course of the year, plus whatever the normal indexing is. And you have to be 75 before June 30th of next year.
Perfect. And Derek, why don't you just take us through the luxury tax as well?
So the luxury tax, not likely going to affect too many people, or or at least not in a big way. If you're buying very expensive cars, over $100,000, boats and planes over $250,000, those kind of things, you're not likely going to be doing that every year. You might do that once in a while if you have that dream car or that yacht that you want to buy. So it's really only going to impact people that either A, have a lot of capital, or B, have a very high income and can afford payments on those kind of things. There will be an extra tax on those particular items. To use it as an example, they're really going after, again, people that have high incomes that finance those things, or people with large assets that will just take cash out of their savings account and buy a $125,000 car or a $250,000 yacht. The equivalent, if you want to call it the poor people's tax, is the kind of extra taxes they put on alcohol and tobacco, those kind of things, because again, it doesn't affect me because I don't smoke. But for smokers, like the cost of a pack of cigarettes, I think if I remember back, it's probably more than one cigarette was when I was younger. So again, they're taxing certain items to try and reach certain ends. So that brings us to the end of our slides, I believe. We did have a couple of questions that came in. I think one was answered. It was about, was there anything in the budget for seniors? So there is, if you're over 75. Otherwise, for those of us younger than 75, I guess we've got a few years to wait before we get any benefit from that, if it doesn't change before then. The other one that came in was, all my working life, I got large tax refunds, and as soon as I retire, I started to owe tax every year. Why is that? Well, I think you might have gathered through our presentation why the reasons might be. When you're working, and especially if you work overtime or anything like that, you're getting taxed, and they don't take into account, in most cases, any RSP contributions you make, any charitable contributions you make, any kind of medical expenses. So you've got income, they're taxing you probably at a little higher than you need to be, and then you've got all these deductions, so you end up getting a refund. Now, when you retire, it's a little, and you have one payee mainly, your employer is sending you the one check, so they know pretty much what most of your income is. When you retire, typically you'll have a pension from your company, if you are lucky enough to have a company pension. You'll get CPP and you'll get old age security. So what the payroll departments of these different organizations do, let's take old age security, for example. It's a little over $7,000 a year. They say, person $7,000, personal exemption is $12,000, age exemption is another something, blah, blah. They don't owe any tax on $7,000. They view it as if that's the only money that you're going to get. So old age security people say, oh, we don't need to take any tax off of this person. CPP, roughly $12,000 a year. They look at it and say, oh, $12,000 a year? Their personal exemption will cover that. Don't need to take any tax off of it. So even if you've got just those two, you've now got $18,000 worth of income with zero tax sent to CRA. And so if that was your only form of income and you had no other investment income, no deductions, you would likely owe a little bit of tax simply because nobody's taking any tax off you. And then if you've got a company pension, let's say that you've got a $20,000 company pension, which is relatively small, but they say, oh, $20,000, they get the pension income credit, they get the age exemption, blah, blah. We only need to take 10% tax off. So now you've had $2,000 taxes taken off, and you've got like a $45,000 income. There's no way, unless you have huge charitable donations or huge medical expenses, that there's going to be enough expenses to offset that. And that's why, as we talked about earlier, that's why you may have to request CPP or old age security to take $100 per check off to go to CRA, or if you've got a RIF, we can adjust that here. But that's the main reason why people end up owing taxes in retirement when they always got a refund. A, because they don't have RSP contributions, which was most people's biggest tax deduction, and they've got little bits of income coming from all sorts of different sources, and many of those sources take either very little or no tax off. So the fact that you didn't pay any tax is why you don't get any refund. Any other questions? We're just at our time, but if there's any other questions you want to pop in the chat screen.
Look like there's any other questions that have come in. So in the interest of your time, we will wrap things up because we're running a little bit over. So thank you so much, everyone, for joining, and we appreciate you taking the time to be with us today. We will be uploading a recording to our website in the next few days once it's been approved by our marketing department. So if you know anyone who wanted to attend the webinar but wasn't able to, there'll be a link available that will be sent out once it's been posted. Derek, anything to add?
Just enjoy spring. We're supposed to be getting more spring-like temperatures from now on till November or December, I think they're predicting. Hopefully it'll be nice, at least for the May long weekend. So enjoy the spring and let us know if you have any questions. Bye
All
for
right,
now.
take care.